All right, well, it's 1 o'clock Eastern Standard Time and 10 a.m. Pacific Time, so I think it will get started. This session is being recorded, so those who registered for it will be able to view it at their leisure. So welcome everyone to this joint INTEGRIS and CCNL information session on how to utilize a personal pension plan to minimize taxes while optimizing your investment portfolio. I'm pleased to be joined by Lauren from CCNL, who will be speaking in the latter half of the presentation about investments. So just some housekeeping. If you are interested in asking a question, please use the chat function in MS Teams. We'll make our best efforts to get to all of those questions at the end of the presentation. And like I've said, we'll also make the slides available for those interested. So we have a lot to cover today, so let's get right into it. But first, a couple of words of general background. We are facing right now a very volatile stock market, mainly driven by a lot of geopolitical matters. We have inflation fears that are starting to create all kinds of policy implications. And the most recent news is that most of the rating agencies are starting to talk about a global recession. So how do we, as individual taxpayers trying to save for retirement, navigate through all of these shoals, all of these problems that we're facing? Well, you'll see in today's session that we have quite a few solutions in our toolkit, and some of these are not well known. So hopefully those who are in attendance will appreciate a lot of the information that we've put together for you today. So our roadmap is I will be taking care of the first two sections, which are an overview of all the tax deductions that come with personal pension plans, and then a review of some of the key tax strategies that further enhance the value of having a pension plan. And Lauren's going to really focus on the enhanced investments. Once you've put the money in the plan, what can you do with solid portfolio management to generate even more returns without taking undue amounts of risk? And I think you'll see that she has quite a few very interesting solutions that can enhance the tax aspects of the pension plan. So I'm the CEO of INTEGRIS Pension Management Corporation. I'm a pension lawyer. I've been practicing pension law for 2 decades, and I'm particularly interested in tax optimization in the context of a pension plan. So you'll see that what I'm talking about is mainly how to minimize having to pay taxes upfront instead of generating wealth through smarter investment strategies. So without further ado, let's get right into the weeds of what are some of the tax deductions that come with a personal pension plan. Well, it's really important before we even get into those to be reminded that under the Income Tax Act, the personal pension plan provides the highest or the largest tax deductions possible over a lifetime. It is more tax effective than any other type of account that's provided for under the Income Tax Act, such as the RESP, the RRSP, the tax-free savings account, and even the classic individual pension plan, or IPP. And one of the things that personal pensions plans do is that they provide additional tax deductions that go beyond what's possible under an RRSP, the annual contribution, because with an RRSP, you have one contribution every year. With us, you can end up with 5 possible tax deductions instead of 1, which means that over time, it is quite easy for a lot of our clients to triple or sometimes quadruple the total tax deductions that are provided by the income tax system to our clients over what's possible under an RRSP, all else being equal. So of course, it's not really a fair fight if our clients access a whole bunch of tax deductions that someone using an RSP cannot access, well, obviously, our clients will end up with significantly more money in retirement than the person who was limited. But it's not just being able to claim larger deductions for contributions. We can also minimize taxes in a whole bunch of different contexts, and we'll look at that when we look at the strategies. So let's look at it from a timeline point of view. Let's see how, being in a personal pension plan, one can deduct along the way through time, with starting at the very beginning and at the end when it's time to start taking money out of the pension plan. So the first tax deduction is the one that is called past service. And past service is when a corporation, i.e. your own corporation, if you're a business owner, or your client's corporation, if you're an advisor to such a business owner, and the corporation is paying T4 income, which could include salary or bonuses or both in previous years. So pension laws allow us to retroactively measure how much we can contribute to the plan had we had set up the plan in a previous time period. So it's a retroactive calculation that we do based on the historical T4 slips or T4 information that we have. And what happens is that creates a corporate tax deduction available to the company that's sponsoring the pension plan. And we've seen past service corporate tax deductions exceed $550,000. So that's a nice way to start at the very beginning. But then we can also do in the first year an RRSP double dip contribution. The reason why we're allowed to contribute to an RRSP in addition to contributing to a pension plan is because the RRSP contribution for this year, for example, 2022, is based on your 2021 earned income, whereas your 2022 pension room or contribution limit is based on your 2022 salary. And because both systems straddle each other in the year of plan setup, our customers are now able to claim a double deduction, which means double the tax refunds, which means more money to spend, et cetera, et cetera. Now, on an annual basis, we can contribute more than what's permitted under an RRSP. That's why I termed the higher annual contributions. And for example, this year in 2022, if you were 64 years of age, or your client had reached that age, they would be able to put $21,000 in change, more than what's permitted under an RRSP at the maximum. And the maximum RRSP this year is $29,230. So this is almost double what's permitted under the RRSP at that age. And it's a little bit less in previous years. And then after age 64, it starts to go down a little bit. But you'll see that this is a significant upgrade over what's possible under the RRSP. In fact, if you were to look at a graph, you can see on this graphic, we have three lines, two horizontal, the dark blue being the RRSP limit, which I've already quoted, and the light gray is the defined contribution or money purchase limit of the PPP. And then the upward sloping curved one that's blue is the defined benefit limit. So when you're young, a PPP customer can use the defined contribution limit. Therefore, they can exceed what's possible under an RRSP. And that gap, just so you know, is about $1,500 this year. But as you get older, when you hit around age 38, 39, then you can progressively put more and more money into the PPP than you could under an RRSP. And that's why the yellow shaded area just keeps getting larger and larger. So in addition to these higher annual contributions, we also have special payments. So special payments are additional tax deductions at the corporate level that arise when the rate of return of the assets inside of the PPP's defined benefit account is below 7.5%. Now, 7.5% is baked into the income tax regulations. So in case people were wondering, why did we pull that number out of thin air? And if you are hovering at 7.5% or above, then you're thought to be fully funded. The assets are growing fast enough to keep up with the promised benefits under the pension plan. But if you're not, for example, if you adopt a hyper-conservative investment strategy, because maybe you don't want to be exposed to the stock market right away, well, you would be generating a lot less than 7.5%. You might be earning zero. So if that's the case, then pension legislation gives the sponsor of the pension plan the ability to write another check that we call a special payment to the pension fund to top it up, to make up for the lackluster returns. And that special payment or that extra contribution is fully tax deductible. Another key feature is that all of the fees, all the investment management fees that normally under an RRSP you're not allowed to write off, it turns out that with a PPP, because we're using a different set of rules, those same fees are tax deductible to the company sponsoring the pension plan. So this, in effect, reduces the cost of investing, because if we can claim a deduction, whereas we couldn't before, we will end up with more money at the end of the day. And the last deduction that towards the end of the process is called terminal funding. Now, terminal funding is probably one of my favorite because it's a huge, massive corporate tax deduction that is optional, but that is available if the client, the plan member, decides to turn on the pension and stop collecting a salary. Normally before the normal retirement age, which for most people is age 65. So if a 55-year-old client says, I'm going to stop taking a salary and I'm going to start drawing on the pension, there's an ability for the corporation to write one final massive check to the pension fund, fully tax deductible, not taxable in the hands of the individual. And that gives the pension fund more money so that the pension fund can offer a higher unreduced pension that's indexed to inflation. So it's a way of accelerating tax deductions in time. And these corporate tax deductions for terminal funding, I've seen them go as high as $2.1 million. These can be amortized and deducted over a 15-year period. So if the individual company doesn't have the cash up front to make that contribution, that's okay. It can be amortized. So here's an example of different terminal funding opportunities at different retirement ages for a sample case. So normally, if you look at age 65 under the basic pension column in white on the left-hand side, you see that normally you're in this case, this individual is entitled to an annual pension of $166,760. However, if that same individual said, no, I don't want to wait till 65, I'd like to start collecting now at age 55, well, you can see that there's a massive drop. There's a reduction in the annual pension that's paid. You can only collect normally $58,826 under the basic pension column at age 55. However, if we do terminal funding, we can add $18,659 as an additional pension to the basic pension, plus put a CPP bridge pension of $21,236. So you end up at age 55 with $98,721, which is not as good as 166, but it's certainly better than 58,000. And in that particular case, if we trigger terminal funding at age 55, if you look at the rightmost column that's highlighted in red, the terminal funding column, you see that the corporation is entitled to a corporate tax deduction of $683,192. So that's fully tax deductible to the company with no income inclusion, no tax consequence for the individual plan member. And there are some other smaller deductions which I'll mention very quickly. Every year after the first year, we're allowed to do another $600 tax deductible contribution. It's a personal deduction that we can put into the RRSP. If the corporation borrowed money from a lender in order to contribute to the plan, the corporation would be able to write off the interest that it paid to the lender, which of course you cannot do if you borrowed money to invest in an RRSP or even a TFSA. And the last point also is that contrary to RRSPs where contributions that are deductible cease at age 71, right? That's the last year in which you can contribute to an RRSP before it converts into a RIF. With a PPP, the corporation that's sponsoring this plan could continue to contribute past 71, not for annual contributions, obviously, but you could for special payments or for terminal funding if you're amortizing the terminal funding over the 15-year period. So for those family businesses, for example, where the next generation is continuing on and the corporation continues to have taxable income, the first generation who's now drawing a pension can receive more money from the corporation through the pension plan. Okay, so that's it in terms of the tax deductions, which you can see from what I've mentioned, dwarf what's possible under an RRSP. And yet 98% of business owners are using the RRSP because that's all they've been told exists. They don't even know about pensions, which is a real shame because they're not utilizing any of these other tax deductions that we've covered. But there's a lot more to this because we also have a number of tax strategies which further enhance the tax position of our clients. And today we're going to cover four, there are more than four, but we're going to cover four key tax strategies. Very quickly, we'll talk about how to protect from the tax on passive income that the federal government brought in back in 2018. We'll talk about intergenerational wealth transfers in the context of a family business. We'll talk about strategies to purify a company in order to create the lifetime capital gains exemption through the pension plan. And we'll talk about pension income splitting at any age, not just at age 65. So you'll see that these strategies can generate hundreds of thousands, if not millions of dollars of tax savings for a business owner that's utilizing a pension plan. So the first one I want to look at is the tax on passive income. It's sometimes referred to one of the more known measures. So what's important is that the assets of the personal pension plan are not assets of the sponsoring corporation. They're off balance sheet. So when the corporation contributes to the pension plan, that money is no longer tabulated when we're calculating the tax on passive income. So what that does, well, one of the things it does is that because we are taking otherwise passive assets off the balance sheet, we are protecting the $500,000 small business exemption because we're not going to be caught by the rule that says if you have more than $50,000 of passive income, your $500,000 small business allowance is ground down on a 1 to 5 basis. And the other thing too is, even if that weren't the case, having passive assets on the balance sheet is not really that great from a tax perspective because those returns are not eligible for the small business rate. If you're going to have passive income, might as well have it inside of a tax exempt entity like the PPP instead of exposing that growth to ongoing high taxation when it's sitting in a non-registered corporate investment account. So there are really two twin effects happening here. We're being smarter about how to tax that passive income, and we're also protecting ourselves from the more no measures because it's not even part of the balance sheet. So this is pretty much what I was saying in other words. All right. The second strategy is the intergenerational wealth transfer, which is probably, in most cases, the most exciting feature of the PPP. And why do I say that? Well, there's a problem with a lot of the classic advice that business owners have been receiving, which is to say that, you know, why don't you just save within your operating company, or if you have a holdco, pump some of these retained earnings intercorporate to holdco and invest in a corporate investment account, a non-registered holdco account, or maybe a family trust, or perhaps just set up some RRSPs and RIFs. So that's what most business owners have been told, because they haven't been told about pensions. The problem with this classic advice is the deemed disposition on death. You know, where there's no spousal rollover that's possible because either you don't have a spouse or both the taxpayer and the spouse die in the same accident or incident. Where no rollover is possible, then the estate is facing a huge deemed disposition. And typically, although not always, we're looking at more than 50% taxation occurring due to this deemed disposition. So same thing with, you know, even if you're using a family trust, we have every 21 year, we have a deemed disposition problem because the trust is deemed to dispose of its assets. So that requires us to do all kinds of transactions to try to mitigate that. So, but with a pension plan, we can do intergenerational wealth transfer, but this is really when we're dealing with family enterprises. So it's not every single client that can use this, but you know, where the children are on the payroll or could be added to the payroll for legitimate purposes, even if it's part-time minimum wage salaries for services rendered to the family business, we have the possibility of passing all the registered wealth inside the PPP from one generation to the next without having a deemed disposition problem. So let me walk you through sort of a practical example. Let's imagine that we have mom and dad who started a business and they have 2 kids and the kids are working in the family business. So therefore, all 4 are receiving T4 income from the family business, which makes sense. They're all employed. So we'd set up a personal pension plan, and it would have 2 aspects to it. In blue, we have a defined benefit account, which is communal in nature. And then for each individual, we'd have a defined contribution and an additional voluntary contribution account. So right now, when there are 2 members, this is what it would look like. But if we added the children to the plan, then of course, it would get bigger. Now, just for mom and dad, there are 2 types of contributions. We talked about them. We talked about the past service, which is shown in red. And we talked about the annual contribution, which keeps going up with age, which is shown by the dotted blue line. So both mom and dad, given their age, it makes more sense for them to be using the defined benefit component of the pension plan. But when the kids are at it, because they're also on the payroll, any past service would be recognized under the communal defined benefit account with mom and dad. And because of their age, and I'm assuming here that the kids are below age 40, it would make more sense for them to use the money purchase limit, because if you remember from the graphic, the defined contribution limit was significantly higher than the defined benefit upward curving line. So to maximize annual current service, you can see the dotted lines pointing to their defined contribution and additional voluntary contribution accounts, which makes sense. So we fully optimize the plan. Now, what happens if mom and dad pass away? Well, all of mom and dad's money is now considered pension surplus, and it hasn't left the plan. It's still in there. But the kids also have a legal right to the monies in the DV account because it's a communal account, and they're entitled to a commuted value or a stream of pension income for the years of past service that we recognize. So now all of that surplus is theirs. They can keep growing it, they can invest it, and will continue to grow tax sheltered for 10, 20, 30, 40 years until they start drawing on it. And even then, only what comes out is taxable. The balance, most of the money continues to grow tax shelter. As a bonus, we don't even have to worry about probate fees because this wealth that mom and dad left behind does not flow through their estates. So there is no provincial probate fees owing either. No deemed disposition federally, no provincial probate fees. This could be millions and millions of dollars that we're not paying to the tax authorities that we're instead leaving for the children. All right, so number 3, purification for the lifetime capital gains exemption. So for those of you who are quite familiar with this concept, business owners who have small business corporations, if they qualify, could get 900 this year's, I believe it's $913,000 of capital gains tax-free upon the sale of their shares to a third party. But there are tests that must be met. I'm not going to list all the tests here, but one of them is you cannot have too much by way of passive assets on the balance sheet of the small business corporation in the 2 years before it's sold. So what most people have done is to remove those assets by doing an intercorporate dividend to a holding company, because then it's no longer the balance sheet. But all that does is it punts the problem to the future and puts that passive income now in an even more tax environment, a passive holdco. What we're proposing under strategy number 3 is that if you're trying to purify the balance sheet, get that money off the balance sheet, or contribute it to the pension plan. Use one of the 5 deductions that we talked about, like thermal funding, for example, to get them into a tax sheltered pension plan. Because not only do you get to purify, with us, you also get a corporate tax deduction. You're not using after-tax money, which is what the intercorporate dividend really implies. You've already had to pay the tax at the opco level before you could declare a dividend to the holdco. We're saying, don't even pay that tax. Just put everything into the pension plan, especially if it's a family business, because strategy number 2, the intergenerational wealth transfer, means that that money is going to come back to you anyway through the surplus. All right, the last one we're going to cover is pension income splitting. So we all know that if you have a RIF, or a registered income retirement income fund, starting at age 65, you can income split that annual RIF amount with a spouse, recorded on the tax return of your spouse, and therefore you would be declaring a smaller amount in your own tax return, and that typically would mean that the couple saves on taxes. So that's only good if you're 65. With a PPP, because it's a true pension, we can split income at any age. We don't have to be 65. So you could have a 40-year-old, especially if we do terminal funding, drawing an annual pension and splitting that annual pension with a spouse. Of course, it makes more sense if the spouse has little or no income, obviously. But this advantage could work for 10, 15, 20, 25 years before it would work with a RIF, because we don't have an age limit. So over time, that can be significant. So just to give you an example, a flavor of what I mean by significant, let's imagine that the annual pension paid out of the PPP is $169,909, $163,909. And in Ontario right now, of course, it's be similar in BC and other provinces. If you don't income split, if you declare the full 163 on your tax return, you'd be paying about $52,000 in provincial federal income tax personally. But if you split that income on the tax return of your spouse, assuming a spouse that has little or no taxable income, then each person is paying tax on half. So when you combine the total tax bill for the couple, we're looking at $34,648, which means that the couple just saved over $17,000 annually in taxes. That's money that instead of going to the government is staying in your bank account. This is just a paper exercise of being able to split your pension with a spouse. It's like a money printing press. All right, so before I turn it over to Lauren for the remainder, the third component of our presentation today, I did want to mention very quickly that when our clients are building wealth, it's not always only about tax deductions and tax strategies. Of course, these are great because they're immediate and they're not subject to the vagaries of the market. They're really guaranteed because the CRA cannot hang on to your tax money if you've claimed a legitimate deduction through the pension plan. But that's only half the story. Once the corporation has contributed all this money and claimed its deductions, someone has to prudently invest those contributions for the long term. You know, of course, so that there will be a pension fund to rely on in life. So that's why I'd like to pass it over to Lauren for the balance of the presentation. Lauren?
Great, thanks, JP. For those of you who don't know me, my name is Lauren Manong, and I'm an investment manager with Connor, Clark and Lunn Private Capital. So I'm going to be talking about optimizing your portfolio in general, because this principle applies broadly, but also specifically within the PPP. And I work with a large number of entrepreneurs, C-suite executives, incorporated professionals, and also high net worth generational family wealth. So I like starting on this first slide because, you know, just like any nonprofit or corporation, good governance and a sound strategy does come in part from having a strong board of directors. And so, you know, I think an important goal is to try and create this informed and aligned informal board of directors for our clients. And many of you on today's call represent other key members, from financial planners to accountants. And so when we start thinking about considering a PPP as part of a client's strategy, you know, the first step is really working with INTEGRIS to run an initial customized projection of what this could look like. And this does involve, you know, bringing together some of the advisors around the board to ideally achieve that buy-in that we're looking for, because we all bring, you know, our skill sets and unique perspectives in order to optimize a client's financial affairs and really make sure that this strategy makes sense for them. So I'm going to focus on, you know, what's on the right hand side of this, which is the investment counselor, because that's our role in this once we have the funds. So I'll talk a little bit about who we are, why we construct portfolios the way we do, and also what the PPP structure enables us. So on that next slide, in terms of a brief introduction, I really think that this will help lend credibility to our perspective on markets as well as future expected returns. Both of these are what drive portfolio optimization. So CCNL has been around for since 1982, and our roots are deeply embedded within the institutional portfolio management space. And so over those 40 years, we've grown to become one of the largest privately owned investment firms in Canada. Providing discretionary portfolio management expertise and services to over 3,100 families across Canada and more than 1,700 foundations, endowments, religious institutions, and Indigenous communities. And just really kind of hanging on to that being private piece, you know, that's really important. It allows us to think entrepreneurially, and that really applies to the clients that we work with, a lot of them being active or retired business owners or incorporated professionals. And our approach to portfolio management is highly innovative, which I will show you as we go. allowing us to deliver results against what is an evolving economic backdrop. And now more than ever, I believe that the success of a company is not solely anchored in the investment performance. That's important, but it's also about the ability to be nimble and pivot, to attract and retain top talent, and really drive that innovation and continuous improvement. And that is something that at CCNL, I think we're well positioned to do. So this kind of goes to the why. Why talk about optimizing an investment portfolio or altering the asset allocation of a client's investment portfolio? And if we think about this, arguably over the last 20 years, roughly, the investment landscape has shifted significantly. And this is really driven by changing economic factors. And so, a big one being the fact that we've had low rates for so long. And while interest rates are rising, our long-term outlook for that asset class is still relatively low. We have peak level profit margins across some key markets, specifically in the US, and that does create headwinds for future equity market returns. And global markets are more correlated or more connected than they've ever been before. So it's that being innovative, nimble, able to pivot piece that's really critical in achieving long-term portfolio success. And so what you're looking at here is, the portfolio on the left, 2005, a very common, still quite common and standard investor portfolio. And so you're all I would think you're all pretty familiar with this 60-40 mix. And this has served clients well in the past. Yeah. Now, our view at this stage is really the fact that this allocation is likely dated as a result of our forward-looking return forecast for that same portfolio is significantly lower than it's been in the past. And that's something, lower returns, that many clients are either unable or unwilling to accept. So the way we see it is, given what we have as today's economic environment, we have really two other options in order to drive those same returns. And so that option in the middle is to materially increase our exposure to risk assets, so namely equities, therefore allowing us to achieve that same 6% return that we were able to achieve historically. But along with that comes a lot more risk. And again, that's something that, a lot of investors are actually unable to stomach. They're not able to handle. And especially actually as we look later in life for them. And so the third option there is kind of the camp that we hang out in, which is to look to diversify using non-traditional assets, something that we call alternatives. So this is a unique portfolio allocation that still drives that 6% expected annual return, but actually decreases our overall risk. And I think today's environment is actually a really good testament to the importance of this diversification. Stocks and bonds historical negative correlation isn't holding right now. And the result is that traditional only investors are left feeling the pain a lot more than others. So ultimately, that economic backdrop and our clients' needs have really driven our innovation over time. And, their success becomes our success, as you can see based on this graph. And so we pulled this back to 1997, which was the inception of our private client group. Previous to that, we were an institutional only shop. And you can see the breadth of our offering has developed significantly over that time. And, if I think back to a quote by Nobel Prize laureate Harry Markowitz, he famously said that diversification was the only free lunch in investing. And I think that piece is really important because what he meant is that while investing, diversification is the only thing that you can do where you're more or less guaranteed to increase your returns without taking on more risk. And that's something fundamental to how we position client assets. So here, this is our investment platform as it stands today. The last slide demonstrated how it's evolved over time. I think the really critical piece here is that it's going to continue to evolve in order to remain competitive against a shifting economic backdrop. And this breadth is really one of our differentiating factors from our peers. We are highly innovative, and this is really driven by our knowledge and our expertise of what institutional investors have been doing for years. And so we believe that the best outcomes comes as a result of specialization and focus. So we have independent teams within the CCNL umbrella, adhering to their own investment process ensuring discipline and consistency over time. And so each piece of this honeycomb really serves its own purpose in achieving the strongest risk-adjusted returns for clients. And so you have, a breadth of return-seeking equities, which provides exposure based on region, style, market cap, and sector. You have then risk mitigating fixed income, which that relationship between equities and fixed income will come back in play when it's different characteristics driving a market downturn. And then differentiated and uncorrelated sources of return through the alternatives. And you can see those in the light gray. And so going left to right, the hedge strategies is a market neutral strategy, which is market independent. And then we have private debt, where we loan to private businesses for expansion or acquisition plans. Both of these are debt alternatives. So we strategically source from clients fixed income 100% to fund those two offerings. And then we have commercial real estate, which consists of owning and operating over 200 buildings in Canada within the subsectors of retail, office, industrial, and a small sliver of multifamily. And then infrastructure, which if any of you are familiar with classic P3 projects, most of our counterparty work is with governments. So on the traditional side, that's, highways, bypasses, hospitals, short line railway distribution assets. And on the renewable side, which is pretty significant for us, that's hydro, solar, wind, and then green hydrogen allocations. And so in the last piece, there's that private equity. So buying and owning and operating a majority stake in private businesses. And that's an asset class that's been typically reserved for the ultra high net worth. So really this is driven again by, if you look at major pension plans, Ontario Teachers, CPP, this is a structure that has been and will continue to be integral to their success. So we really try to emulate it for the private client side. Looking at risk and return, I think this is really important because, here you can see expected return on the vertical axis there. Horizontal is the volatility that you can expect from each asset class. And so, not surprising, cash bonds are shown on the bottom left, low expected return, low risk, and then equities on that upper right area with much higher expected volatility and greater returns. I've nicely circled the alternatives, which fall in the middle, really reflecting the fact that they provide attractive returns within lower expected volatility than equities bring. And so when we look to incorporate these in a portfolio, what we do is we reduce fixed income, and then we reduce fixed income and equity exposures, improving both the risk and return metrics within a portfolio. And I will add on this that, suitability is important. We look at each client's unique objectives and tailor it as such. And so we do help them understand that, like anything, there is trade-offs when it comes to investing in these. And, the big ones would be complexity within the portfolio and lack of daily liquidity on some of the assets. So going to the next slide, I just want to show you how, if we compared status quo versus enhanced diversification, I think that this will really help solidify the importance of optimizing the portfolio. And so status quo, we've diversified it as best as we can within traditional only asset classes. So you have 60% to equities, 40% towards bonds. And then on the right is the enhanced diversifications. We've used all the tools that we have available to us in order to drive that return. And so some big changes is, a material drop to fixed income, a more modest drop to equities, and then between the hedge strategies and the alternatives, allocating 28% there. And so let's take a look. I'll show you both the metrics in terms of return and risk. So on that next slide there, you can see these are forward-looking range of return projections for the two portfolios over 20 years. And this is really, again, the camp that we play in, because for any client coming on, as much as historical returns are helpful to see the performance of an investment firm, there's literally no benefit to a new client coming on. We want to show them what they're going to experience, and I've talked about how economic kind of in changing fundamentals really can alter that. So this is a box and whisker plot, meaning that 80% of returns, or the way I like to think about it or explain to clients, is 8 and 10 years, and of annual returns will fall within these quadrants. And so, not surprising that the enhanced diversification portfolio increases the median return. It decreases the downside potential, so moving it from negative 5.3 to negative 4%, and then also increases the upside. So while that sounds good, I think we need to think of it in the context of risk, which is equally as important. So this is the probability of peak to trough decline within those same 20 years. And peak to trough, just for reference, if we think back to the 2020 cycle, peak was somewhere at the end of February. The trough was March 23rd. And so we want to know, given, the various cycles that we have within those 20 years, and with those cycles, we know that each one is unique in its equity market drawdowns. What is the probability of those declines? And we really try to focus in on that 20% decline, because that's actually more or less when investor behavior starts to change a little bit more of the emotional drivers start to take over. So we think it's really important to help quantify that. And so you can see on a portfolio like the one I chose, it does drop it down from 36% to 24% just by reducing the amount of equities within the portfolio. So what does higher expected returns with lower downside risk drive? And on that next slide, you can see that, it's not rocket science, it's overall wealth creation. And so, if we had an investor who put $1 million in 20 years later, they'd roughly have almost $1 million more in wealth just by choosing the right asset classes to hold within the portfolio. So that's that general optimization piece. If we think about this within the context of the PPP, just solidifying some of the things that JP mentioned, we can lend to a steeper line on that purple line, because we're going to be able to shelter more wealth within the PPP to grow or compound tax deferred. And JP will actually quantify that number for you at the end. And then we can also shelter high return generating alternative assets within the PPP. Also a very unique thing that the PPP can bring, because that's usually something that's reserved or required to be held within a taxable account. So there's more flexibility to shelter that within the PPP. And then lastly, we can move to deduct the investment management fees. So arguably leaving more money left in the portfolio to increase that line over time. So I'll end on my slide, on this last slide here, just in terms of tax efficient investing, because this is always top of mind for us. I will note that most firms, many firms treat these accounts as completely separate. And so what we do rather is we look at a client's strategy holistically across all those accounts, and then we intentionally allocate asset classes in the account that makes the most sense from a tax perspective. So an easy example for you is, allocating all small cap equities or global equities within the tax-free savings account because of their growth potential. And so if we look to move forward with a PPP strategy, there's a lot that happens behind the scenes with us in conjunction with INTEGRIS and with the client's accountant. And you can see there the three accounts that get added, and JP's talked to the various ones as we've gone, but those are the three PPP accounts that get created. And then there's various moves that happen. So we get directive in terms of the amount that needs to go from the RSP over to the DB. That's a required transfer. So you can see that one line item there. Any excess that's held in the RSP, we have the option of putting it into that additional voluntary contribution account, the AVC. Why clients might look to do that, again, is kind of what I mentioned previously, is the tax deductibility that brings, and the greater flexibility of the asset classes that we can hold within the account. And lastly, often we'll have a client's holdco, and so the move that we make is we can do a eligible contribution as part of a corporate buyback. And so again, this is transferred into the DB and is viewed as a corporate deduction. JP mentioned, the assumed or prescribed rate of return within the DB account. And so working in conjunction with INTEGRIS, we design it so that, again, looking holistically, the fixed income sits within the DB account in order to fall below that prescribed rate, allowing the client a special top up. So I hope my part has provided some perspective in terms of why portfolio optimization is so important and some of the additional advantages that the PPP allows for. JP, jump in on this piece if I've missed anything in regards to the PPP structure. Otherwise, I'll pass it to you to wrap up.
No, Lauren, this is a really, really important stuff that you've covered, because often people don't always realize that alternatives can provide a nice hedge and are not, in the public opinion, often people think, oh, alternative, that's risky. No one would want to do that. And meanwhile, pension plans have been doing this for decades. So if multi-billion-dollar institutional pension plans are doing this, there's a reason. And CCNL, because of it, I guess because of its institutional past, has maintained that with the private wealth division, and I think that's really important. Just going back to what Lauren was saying earlier about, if the rate of return is 5%, whether you're in an RRSP or a PPP, because we're allowed to put more money in a pension plan than under an RSP, there's going to be a gap that develops there as well. And in this particular example that we're looking here, we can see that over time, the annual contributions are larger than under an RSP. So the right column says RSP contributions. You can see them and compare them very quickly with the leftmost white column, which is the PPP current service contributions. So right away, you can see that there's more money that's growing. And so by the end of the projection period, when you subtract what you would have been able to put had you maxed out your RSP, assuming the same rate of return as if you were in a PPP, well, you can see that we're looking at least $500,000 of additional registered dollars available to the PPP customer. Now that assumes a 5%. Now, if Lauren's assumptions hold true and we can increase that from the status quo, the classic way of doing things, then of course these numbers are way too conservative. They don't really reflect the true extra value that will be available. So just to wrap up, because we're at the hour, what we've done is we've combined the significantly enhanced tax deductions permitted by pension laws with the tax-free growth that is common both to an RSP or a pension plan. But given that we've got more money working for us, and then Lauren's powerful tax and enhanced investment strategies can create a material increase in net worth or wealth over time, especially for the plan member, the spouse, and the children. If the children are also working in the business, then we have the added value of all this wealth transferring to them with no immediate taxation. So how do our two organizations work together? Well, INTEGRIS takes care of anything that's not investment related. So administration, legal interpretation, compliance, structural recommendations, tax optimization, all that stuff is INTEGRIS driven. Our actuaries crunch the numbers and provide the information reports that are needed. But Lauren's team at CCNL really takes care of building that portfolio and managing it, optimizing it. And then, of course, the accountants have to give their final blessing to move forward, because the pension plan forms part of a broader corporate planning strategy, typically, which often involves investment corporations, holdcos, family trusts, and other structures. So when we introduce the pension plan, we need the buy-in of the accounting community. So that's really how the teams of professionals come together to generate that extra wealth that everybody's looking for. Now, in terms of next steps, if you are interested in getting a complimentary illustration, you can reach us, you can reach Lauren. We have our website online questionnaire showing here. It's a secured online questionnaire, integris-mdt.com start. And typically what we ask is dates of birth, province of the business, the balances for RSPs, any unused RSP room, which you can see from your notice of assessment. If we're going to be buying back past service, or even for the current year, what is the T4 that is being paid or expected to be paid, and what was paid in previous years? The date of incorporation and employment, and then whether or not you already are sponsoring other pension plans, which typically the answer is no. So with these few data points in hand, we're able to generate the types of illustrations that we were showing you earlier. So that's the end of the formal portion of the presentation. We'll now open it up for questions, if there are any.
And JP, Victoria actually asked a question in the chat. If you want to just reference it, that
Oh, okay.
it falls within your domain.
I don't see the question. Can someone just?
You want me to read it to you?
Yeah, if you don't mind.
Okay, so it says, if you transfer passive assets to the PPP to purify the operating company in preparation for a sale, does the PPP get sold along with the OpCo, assuming the OpCo is the owner of the PPP?
Okay, great question. So what we do normally is we'll have a holdco sponsoring the PPP, and OpCo, the one that's being sold, listed as a participating employer. So under the past service or terminal funding rules, or whichever rules we're using, OpCo would be taking that passive money off its balance sheet, putting into the pension plan. And once the operating company shares are sold, it ceases to participate. So it's cut off from the pension plan. And the holding company that is still owned by the selling group, by the client, would continue sponsoring the pension plan on a go-forward basis. So that's how we get our cake and eat it at the same time. Claim the deduction, sell the business, purify it, get the lifetime capital gains exemption, and maintain the tax-free status of the pension assets, thanks to Holdco continuing to sponsor the plan on a go-forward basis. Any other questions? Lauren, do you see any other in the chat?
Nope, that's the only one.
That's it. Okay, perfect. Well, I guess we were crystal clear. So again, this is just the starting point of a conversation. Please, if you have more questions, send them by email to Lauren or myself. And we will be sending to those who are interested, we're sending these slides so you can have them handy. We're past our time, so I would like to thank everybody for attending, and we'll certainly be looking forward to further conversations with the attendees if there's interest in personal pension plans. So thank you so much, Lauren, and we'll say goodbye now.
Great. Thanks everyone for joining.
Bye-bye.